Now when it comes to investing, one key thing to have at the back of your mind is the target price of your investments. And in this video, I will share with you how I calculate the target price and the expected returns of my investment using a modified form of the relative valuation model. Without further ado, let's get started. Relative valuation model explained. The main question that we are trying to solve with the financial modeling is the question of what is the likely target price of the investments at the end of X number of years? To answer this question, I will forecast and stress test two aspects of any given investments. The first is the assumed earnings per share growth rate, and the second is the future valuation multiple that the investment might be trading in. For those who are unfamiliar with either of these concepts, earnings per share refers to how much money an investment makes per unit of share of the investments, while the valuation multiple reflects the willingness of the investor to pay for a given investment. The valuation multiple that I am using for the purpose of this modeling is the price to earnings ratio, which measures the investor's willingness to pay for $1 of earnings per share of the investment. In essence, I'm trying to forecast the target price while assuming that the earnings will grow at different percentages and keeping the investor's willingness to pay at a constant rate. Or forecast the target price given different degree of the investor's willingness to pay while assuming that the earnings will grow at specific percentages. Now with all forecasting models, the biggest challenge is to ensure that your assumptions remains reasonable and realistic so as to ensure that your forecast accuracy remains high. And that brings me to my next point. How to keep your assumptions reasonable. To keep my forecasting assumptions reasonable, I will always reference the long-term average, which spans over 20 years investment horizon for both the earnings per share growth rate as well as the valuation multiple. From there, I will make judgments as to whether or not the past performances are sustainable moving forward, or should I revise the figures upwards or downwards. For example, if the compounded annual growth rate of the earnings per share over a 20-year period is 5 to 6%, the question that you're going to ask yourself is if it is reasonable to assume that the earnings growth in the future will exceed this 5 to 6%, or should we revise our expectations downwards? As a rule of thumb, for the developed markets like the US and the Europe, I will always revise the long-term growth estimate downwards, as it is not reasonable to expect them to grow faster than before, just as it is not reasonable to expect an adult to grow faster than a teenager. For developing markets, just to be conservative, I will keep the growth estimates to be either the same as the past performances or slightly lower than the long-term average so as not to overestimate its future growth rate. With regards to the valuation multiple, I will forecast 3 different scenarios to simulate an overvalued, fairly valued, and undervalued investment market environment. Once again, the main reference that I will refer to is the behavior of the investment multiple over a long-term period. As a rule of thumb, I will use the long-term average to simulate a fairly valued environment and then add a sufficient buffer above and below the long-term average to simulate an overvalued and undervalued market situation. Once you have your forecasted figure, what's left is to calculate the target price, and that brings me to the next point. Deriving the target price and expected return. Given that we have calculated the forecasted future earnings and expected price to earnings multiple, to derive the target price, all we have to do is just to reverse engineer the price earnings formula to calculate the target price. Now what I like to do is to come up with a range of forecasted earnings per share, and then from there, you reverse calculate the target price based on the different valuation multiple environments. Doing so will allow us to have a gauge of what the likely target prices will be given the different scenarios. From there, we can then reverse calculate the annualized expected return based on the target price over a specific investment duration. This will help us gain a better clarity as to what the expected return of your investments will be if you were to invest today given the different scenarios. With that quantitative information in mind, the next step is to make sense of the numbers by integrating them with a qualitative analysis. From there, you will be able to derive whether is it a good time or a good price to invest or divest. Having a financial model that you can rely on will enable you to make decisions based on facts and figures instead of irrational emotions. And it will drastically improve the quality of your investment decision and hence improve your investment performances. Now, if you do not know how to get started with your investments, or if you do not have the time to manage your investments, you You can check out what I do on my website to see how you can benefit from my investment planning services and reach out to me directly. Do subscribe to this channel or follow me on Instagram to receive a 1-minute daily market updates and be updated with the weekly upload. Stay safe and I hope to hear from you soon.